Hello everyone and welcome back. In this video, I want to talk about how I would create a winning stock portfolio as soon as possible if I started from scratch, if I had to do it again. In this video, we'll talk about the fundamentals, the structure, how to build a winning portfolio, how to only select good quality stocks and avoid as many traps as possible. Because a lot of people ask me, how do you create a portfolio that outperforms the market? How do you beat the market? And the other question people miss is, how do you avoid as many mistakes as possible? Because now we live in a golden age of information. Too many YouTube videos, too many Twitter posts, too many Substack articles, too many forums online, too many AI generated posts, too many AI generated content. People talk about this too much. People have too much information and people don't know how to process all this information. So a lot of people that are very smart consume all this information, but still they don't know how to beat the market. Now, good way of knowing if you will be a good investor or not is not the amount of information you consume, but how you consume the information and how you process the information. Can you know what is true? Can you know what is fake? If you don't know this, you're just consuming and being brain rot by all the videos you see online. So in this video, I will give you some tips how I would create a new portfolio if I just started today. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And I can tell you, concentration has been a wonderful help for me. So first of all, what is the kind of portfolio I would create? I would not create a diversified portfolio. I would create a 10 by 10 portfolio, actually. 10 stocks, and for each of these stocks, you have a 10% allocation each. That's it. This is the rule that was inspired by Monish Pabrai, great legendary investor. A 10 by 10 portfolio, 10 wonderful companies, 10 wonderful bets, concentrated bets, few bets, long-term bets. Speaking about long-term, for this portfolio, if I had to create it again, I would not focus on short-term trends. This will be a long-term portfolio, right? And if you want a long-term portfolio, it means low turnover. You don't make a lot of transactions every year. You don't buy and sell things every month. You buy and you hold for years. And how do you select the best companies that you have to allocate 10% of your portfolio? Well, this is where the research starts. And I would only, if I had to start it again, now the market is a little bit high. So I would only focus on companies that are not egregiously overvalued. What do I mean by egregiously overvalued? Extremely expensive. You can look at a ratio called the PE ratio. You never go above 50. This is it. You have the PE ratio, the price to free cash flow. You just never go above 50. Boom. You remove thousands and thousands of stocks. Also, you remove companies that are not profitable. If a company is not profitable, they will not have a PE ratio. On financial websites, you will find impossible to detect the PE ratio because you have no earnings in the PE ratio. Price earnings, if you have no earnings, you have no PE ratio. You remove it. I would only invest in 10 companies that are profitable. Companies that have been profitable for the past 10 years. Companies that have been growing meaningfully. What is the good growth rate? Well, if I had to start it again, I would use a screener. And I can do it live during this video. So I will give you even more proof of my hunting ground. I can show you the screener that I would use. So after watching this video, you can do it at your home. I will use the screener from Fiscal AI. This is the best screener. Let me repeat. If I had only one screener to use, that would be this one. So I highly recommend you use Fiscal AI. And if you want to use Fiscal AI to create an account, I have an affiliate link, minus 15%. You click the link in my description, it will get 15% cheaper, and you can try the website completely for free without putting your card for 2 weeks. So you have literally no excuses to just use this screener. If you like the screener and you like the tools, you continue and you will get cheaper because of my link. And if you don't like, that's it. No cards whatsoever. You can just continue with your life after this. So please use my affiliate link or you're just wasting your time. Okay. First of all, let's start from the beginning. We said we want companies with a PE ratio that is below 50. Price earnings, PE ratio between 0 and 50. So only companies that are profitable. We want companies that have been growing. So you can check the revenue for the past 10 years. You want this to be above 0. Of what? 5%? You want the revenue to be growing a little bit. Now, geographically speaking, if I had to start my portfolio again, I would not focus specifically on some countries or some continents. US, Canada, Singapore, Japan, Korea, anything can be possible. You can find quality anywhere in this world. Some people would prefer to only invest in the US, understandably so, but not particularly I'm agnostic when it comes to geographies, if I had to start again. But I want to remove some industries that I think are too cyclical, industries that are too complex, industries that are filled with traps. So again, if I had to start again from scratch, I would remove pharmaceuticals, I would remove metals and mining companies, and I would remove all the biotech companies, biotechnology. You put the toggle on, exclude industry. Okay? So we have many results right now, a P/E ratio that is positive and below 50, and a revenue that is growing for the past 10 years. You will have many results. The limit on the upper side is 250 results. So let's add other filters. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. First of all, let's put a revenue growth rate of 10%. Second of all, we want to only be invested in companies that are growing their earnings per share, that have grown their earnings per share. Maybe 10%, but I can do a little bit more than this. 15%. I believe in the very long term, 10, 20, 30 years, stock prices will follow earnings per share. So if you have a company that is growing earnings per share at 15% per year, the stock price will do 15% per year. And now we go down in results from 250 results to 86 results. This is a good hunting ground. If I had to create my portfolio from scratch today, I would look at all the companies in this list. All of them. Literally, you start with the first one, you end at the last one. And I would look at everything and ask the same questions over and over again. First question, do I understand the business model? How do you know if you understand the business model? Do you understand the segments? Do you understand how they make money? Do you understand who are the customers? Do you understand what is the track record of the company? What is the history? What is the vision of the company? Why will they be a leader in the future? Can you explain in simple words what they do? How they make money? Second question, are these companies in a growing industry? I only want to be invested in companies that are in a growing industry because a rising tide will lift all boats. So even maybe the company will have some problems, some slowdowns in the future. That is fine because the industry is growing like 10% per year. I can take the example of the cybersecurity industry growing right now 12% per year. Even if the company has some specific problems, short-term problems, a rising tide of growing 12% per year will lift this cybersecurity company. Okay, so just by asking these two simple questions, like understanding and growing industry, maybe half of them will be dismissed. Half of these companies will be dismissed. Okay, I see some very good companies in this list, actually. Very, very good companies, and I own some of them. So yeah, that tells you a lot about the quality of this screening tool. And you can use this tool only on Fiscal AI. Something that I can add, because right now I think inflation is here to stay. I think this is my opinion, but I think if I have to create a portfolio right now, I think the next world will be inflationary, and I think it will be very hard for the world, in the US especially, to lower the inflation rate. So I think inflation will be above 3%. 3-4% for 1, 2, 3, 4, 5 years. What kind of companies do I want in my portfolio to outperform the market if I think inflation is here to stay? I would say I want my portfolio to be filled with companies with pricing power. So pricing power is the ability of a company to grow their prices more than inflation. So if you go to a Starbucks coffee, prices are going up every year. So if inflation is 3%, they can increase the prices of their coffees at more than 3% per year. So it's a brand that has the ability to have pricing power. Same thing for Ferrari cars. Ferrari announced in 2025 that they would raise their prices by 10%. Nobody moves. Nobody cares. Customers will pay 10% more. Actually, Ferrari has the best customers in the world because they are very happy to pay more. A Ferrari car is about status. If the price is getting higher, it means fewer people can buy Ferrari cars. So it's more exclusive, it's more limited. So it's higher status to own a Ferrari, which means in economics, we call this a Veblen effect. Veblen good. If the price is getting higher, more people will want it. It will get more premium, more value. It's crazy, but this is how some businesses work. I can give you another example with the French brand Hermès. You have bags that are worth tens of thousands of dollars, hundreds of thousands of dollars. When the price is high, people think it's of value and people want it more. So some customers in this world are very happy to pay more because it's a sign of status. And I only want my companies in my portfolio to have this kind of pricing power. Not to the extent of Ferrari or Hermes, because you don't have that many companies in the world that are doing this, but I want some sense of pricing power. And the way to measure pricing power is by looking at the gross margin. You can look at qualitative aspects, the relationship with their customers, etc. But you can also look at the gross margin. So, gross margin, gross profit margin, I want it to be, let's go progressively, right? If I put 40% minimum gross margins, the results in this screener go from 86 companies to, let's check, 60 companies. Now, if I want to increase the threshold again from 40 to 50% gross margins, we go from 60 companies to, let's check, to 44 companies. Now, if I want to continue this, now we are getting in a very good business model, good pricing power. If I put 60% gross margins, the results will go down again and we will go from 44 companies to 32 companies. This is a very, very good hunting ground if I had to start again from scratch. If I wanted to create a portfolio right now, I would invest in these companies. I would do the due diligence of these ones, see if they are located in a growing industry, see if I understand the business model, and you can pick the 10 best companies. I would pick the 10 best ideas I have out of this list. So now what can you do? You can do this exercise at home. As I told you, you just have to click the link in the description right now. You will have an affiliate link, 15% cheaper for you to use Fiscal AI and do the exercise right now. And you can try the website for 2 weeks completely for free without putting your credit card. And if you like the website, you can stay. I think it's maybe the best investing website out there. It's not free, but it's worth every penny. I think the value you can get out of Fiscal AI is huge, and I'm using Fiscal AI on a daily basis. And I've been using this website for years. So it tells you everything you need to know to just click on this link, in this affiliate link, and use this screening tool. Some people may twist some things in my screening tool. You can play around with some margins. We can play around with some growth rates, PE ratios. But if I had to start a winning portfolio right now, this is what I would do. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.